Are you tired of watching your portfolio underperform, stuck in outdated strategies? Many investors feel this frustration, seeing red charts and missed opportunities. Traditional diversification is outdated. It's time for a smarter approach. Momentum drives smarter allocation, protecting your downside while multiplying your upside. It's not timing the market, it's adapting before it moves. Discover the allocation strategy that adapts in real time.
If you're a business professional and you're struggling with market swings, second-guessing every move, or wondering why your portfolio feels like a part-time job, this episode's for you. Most people think performance comes from a hot stock or the perfect timing, but the truth, over the long run, asset allocation explains most of your outcome. Not that one trade you brag about. Allocation isn't about prediction, it's about positioning. It's not about saying no to growth, it's about saying yes to the right mix of your goals, taxes, and timeline. And here's the kicker. Without a clear policy and guardrail, even a strong market can leave you with weak results. Today, I'll show you 3 simple shifts that can turn allocation into a calm, repeatable system that buys back your time and protects what matters most. Let's dive in.
You're watching My Hybrid Retirement Weekly, the show that helps professionals work less, earn smarter, and embrace more financial freedom. Hosted by Rob Leiphart, a fiduciary advisor. New episodes drop every Tuesday at 12 p.m. Eastern. Subscribe now and start planning retirement on your own terms.
Let's do a quick reset before we dig in. My aim today is to clarify without jargon. I'll keep it practical so you can act this week. Hi everyone, Rob Leiphart here with My Hybrid Retirement Weekly, where we turn complex finance into clear, purposeful strategies so you can care for the people who matter most. In control or at the mercy of the headlines. Today, we're unpacking the most powerful asset allocation strategy to build durable wealth, reduce anxiety, and create retirement income that doesn't need babysitting. Let's start with why allocation matters more than most investors realize and why it beats chasing what's hot. Here's where we get real about the problem behind the problem. Chasing returns feels exciting until it doesn't. I've seen professionals increase savings and still feel off track because the mix wasn't aligned with real life needs. Think of allocation like a flight plan. Without it, turbulence feels terrifying. With it, bumps are expected and manageable. Get the mix right. Let rebalancing and tax location do quiet compounding. Here's some common pain points. Overconcentration. Think employer stock, one sector, one country. Cash drag. Just waiting for those perfect entry points. The third, silent risk creep when winners grow and you never trim. And fourth, taxes eroding returns because assets aren't in the right accounts. I have a question here from Harper in Portland, Oregon. I tweak my portfolios constantly. It's endless maintenance and nothing sticks. What am I missing? You're not the issue, the process is. Without a written policy and guardrails, every headline feels urgent. We're moving from reactions to rules. So the system, not your willpower, does the heavy lifting.
Imagine owning 10 stocks that all crash together. Oops. Studies show that holding 8 to 16 stocks cuts most company-specific risk, but if they're all in the same sector, a single shock sinks your whole pile. True diversification spreads money across uncorrelated buckets, sectors, geographies, and asset classes like bonds, real estate, and commodities. Crypto bras buy 50 coins, but most just mimic Bitcoin's moves, offering zero real hedge when BTC dips. Don't put all your eggs in one market basket. Mix uncorrelated assets to smooth returns and survive downturns. Remember, diversification isn't a number, it's uncorrelated variety. Subscribe for more investing truths.
Okay, so if the problem is a missing process, What does a workable process look like? Let's build it. Here's the blueprint. Simple, sturdy, and designed for real life. Shift 1, from guessing to a written investment policy statement, or IPS. Write a one-page IPS with the following ingredients. First, define your targets. As an example, 60% global stocks, 35% bonds, and 5% to alternatives. Define yours. These are unique to you. Second, drift bands. This is your action if one of those sleeves mentioned above in those targets moves 20% above or below your target. So if in the example above you set 60% stocks as one of your targets, you're taking action if that sleeve moves above 72%, or conversely if it moves below 48%. These bands define where you take action. Third, define a rebalance cadence. This is simple as just checking your portfolio quarterly and see if it's drifted within those bands that you've created for yourself. Fourth, cash flow rules. Send new contributions to underweight sleeves first, or to a new allocation or target that you want to take on. Again, define where new cash goes. Fifth, your behavior rules. In a 20% market, a down market that is, you're going to rebalance in 2 stages, half now and then half in 30 days. Whatever rules you want to set forth for action when the market goes south. This replaces anxiety with action. Shift 2, from one pot to time windows. You have a now window, a soon window, and a later window. Match time horizon to risk so volatility becomes background noise. Let's define those 3 times. Now is from now to 2 years out, and it's to satisfy immediate cash needs. So here you want to think cash, money market, short-term obligations, bonds, treasury bills, CDs, something short-term in nature. The second group, soon. This is 3 to 7 years. You want this invested, but you can afford to lock it up for a little bit longer and take a little bit more risk. Think quality bonds or value stocks or dividend-paying stocks. You still want some returns, but you want the ride to be a little bit smoother. And the third bucket is your later bucket. This is 8+ years. It could be your global equity, domestic equity, small stocks, quality stocks. This is where you're taking on a little bit more risk because you have time on your side, but it still needs to align with your risk tolerance. An example here, if you plan in retirement is to withdraw $60,000 a year, hold $120,000 in the now bucket. This way, if the market drops, you aren't forced to sell stocks at a loss that might be in the later bucket. The third shift, from random accounts to tax location. Put the right assets in the right accounts to raise after-tax returns. Tax deferred produces ordinary income at a later date. Taxable, you might want to think about investing in municipal bonds or some sort of long-term capital gain-oriented investment. Roth or after tax, this is where you want to put your growth. Let the upside grow tax-free. In this bucket, even 0.5% to 0.8% annually tax-free, getting that sort of advantage can compound meaningfully over a decade. I have a question from Nolan in Atlanta, Georgia. I don't have time to rebalance every blip. Can this be hands-off? Yes. Use a calendar combined with the bands idea above. Review it quarterly. Act only when the sleeve breaches the band. You capture 80% of the benefit with only 20% of the effort. Diversify across U.S., international, emerging. Maintain high-quality fixed income with the right size duration. And if you're using alts, think liquid or modest returns and with a clear job. You've got the blueprint. Now, start now, not later.
What is portfolio rebalancing? Portfolio rebalancing is the process of adjusting your asset allocation to keep your investments aligned with your needs and goals. Here's why rebalancing can be crucial for investors. Risk management prevents any one asset class from dominating, protecting your portfolio from excess risk. Investment objectives keeps your portfolio aligned with your goals and risk tolerance. Lock-in profits allows you to take gains from high-performing assets and reinvest for more growth potential. Long-term strategy prevents short-term market swings from influencing your long-term goals.
A single seed grows a forest, and timing your start is one of them. Sequence Risk 101. It's not just average returns, it's the order of returns. A big loss early in retirement can damage sustainability. Bucketing shields near-term withdrawals from selling low. Rebalancing enforces buy low, sell high. Tax location preserves more of what you keep. Here's 3 near-term wins. Cash runway. You choose when to sell. Second, lower stress at home. Having rules is better than debates. And third, compounding. Fees, taxes, behavior, they all add up. I have a question here for Sienna and Phoenix. Should I wait until I'm earning more before I build all of this? Sienna, income is the engine. Allocation is the steering. More horsepower without steering just gets you lost faster. Start small, automate, and let the plan scale with you. Let's lock this in with a quick recap and a side-by-side example you can picture. Here's the whole picture. Then we'll put it to work. Here's your recap. Policy and investment policy statement beats panic. Time windows turn volatility into background noise. Tax location lifts after-tax returns. And fourth, calendar plus bands keeps you disciplined. Here's an example with a little mini case study here. The Parkers and the Garcias. 2 couples, early 50s, both have $1 million, both save $2,000 a month. They have the same income. The Parkers are reactive. No IPS. Their portfolio is drifted to 85% large cap value, large cap growth. Bonds in there are taxable. They have a higher tax drag. They don't have a now bucket at all. So they sold stocks in a 20% drop to cover expenses. 5 years later, they have lower equity share because they sold low. They have higher taxes, and the retirement's delayed. On the other hand, we have the Garcias. They've got a 1-page IPS, and it spells out that they're going to put 60% in stocks and 35% in fixed income and 5% in alternatives. They've got their plus or minus 20% band for their rules. In the now bucket, they hold 24 months of expenses. In their soon bucket, it's invested in some quality bonds. And their later bucket, it's invested in stocks and some exposure to small cap. They have bonds in their IRA, 401k, equity, ETFs in their taxable account, and growth tilt in their Roth. During the same 20% drop, they drew from the now bucket. They rebalanced twice per their plan, put some money into their underweights and sold from their overweights. And 5 years later, their glide path is intact. They're paying lower taxes. They have higher confidence, and their retirement date's unchanged. Same market, same savings, different outcomes. And the difference wasn't luck. It was alignment and discipline, and built into their allocation. Ready to build yours? Here's how I'll help you get it done. Let's move from now knowing to doing in the next 30 days. If you want clarity on your mix schedule an allocation power session today, and we'll translate your goals into a one-page investment policy statement, targets, bands, cadence, map assets into now, soon, later, with the right risk for each goal. And third, we'll optimize tax location and set rebalance rules so the system works while you work. Subscribe every Tuesday at noon for My Hybrid Retirement Weekly so you'll never miss strategies that protect your purpose and your people. This has been My Hybrid Retirement Weekly. I'm Rob Leiphart, fiduciary first, family always. Until next time, stay intentional, stay balanced, and keep building a retirement that doesn't need babysitting.